the market is pricing maybe close to around 60 basis points of cuts from the peak in May until the end of the year. So there is definitely some kind of mismatch coming through. But the thing is, I would say on the Fed rhetoric side, there has been a shift. I mean, over the past probably 2 weeks or so of my monitoring of the Fed speakers, certainly they've been raising a lot more uncertainty around credit conditions. I think that's the big risk. I think that's why people are thinking, the Fed finds it very difficult to come out to tell people that this is going to supersede what we're seeing on the inflation front. And that is inflation still high and still uncomfortably high. But the thing is, I think the Fed will continue to remain relatively hawkish, but then, of course, continue to signal that there's these downside risks, which I think the market is kind of fair to think about the risk that policy is at the peak.
Sorry, could they sound hawkish, act dovish?
Well, I think they will certainly still sound quite discontent with the inflation backdrop. I think inflation, no matter what, is still well above their target level. I think that's something that they will still continue to reiterate. But I think the question is really about, the outlook on, let's say, growth, loans, right? Whether these factors begin to come off a lot sharper in the upcoming data. We had a little bit of relief last week with the non-farm payrolls. Before that, the market was starting already to panic. I think even the Fed themselves were starting to think that maybe we need to pause. And that's exactly what we heard from, for example, Goolsbee last night, suggesting that let's hold off, let's wait. The financial related risks are still there.
So Nomura was, I think, the only house, which was an outlier at the last meeting, that was predicting a cut. And I know that you're not the author of that report, but I just wanted to discuss the fact that if you're talking about 60 basis points of rate cuts in the offing, and that's what the market is pricing right now, do you not think that that is reflective of the fact that the economic outlook could be very, very bad? Wouldn't that be predicated on the fact that we could perhaps expect a hard landing, which is not the Fed's base case scenario? So in that sense, you're fighting the Fed.
No, I wouldn't actually. So I would say that 60 basis points of cuts to me is actually more a kind of soft landing. I think it was more a hard landing if there's kind of financial stress to really build up financial sector, seeing perhaps a few more banking events come through. Then I would say actually the risk is the market has to price in even more. And it won't be, these small increments of cuts. In fact, there could be bigger cuts to resolve the financial stress that comes through on a hard landing scenario. So I think actually the market is more still kind of towards the neutral, possibly towards the kind of soft landing scenario. It hasn't gone really for that hard landing yet.